In the spring of 1971, a quiet decision was made behind closed doors in Washington that most Americans never heard about, never voted on, and were never asked to approve. Richard Nixon, facing a dollar crisis that threatened to unravel the entire post-war financial order, severed the last remaining link between American currency and gold. Just like that, without a referendum, without a national debate, without so much as a press conference that most people paid attention to, the dollar became something entirely new, a piece of paper backed not by any physical asset, but by a promise. And then, 2 years later, that promise was reinforced by something almost no one talks about in mainstream financial education even today. The United States struck a deal with Saudi Arabia. Oil, the single most essential commodity in the modern industrial economy, would be priced and traded exclusively in dollars. Every nation on Earth that needed oil, which was every nation on Earth, would need to hold dollars to buy it. The petrodollar system was born, and for 50 years it was the invisible foundation beneath every aspect of American economic power. Now, in 2026, that foundation is cracking, and the cracks are not hairline fractures that engineers can patch over a weekend. They are structural. Saudi Arabia has been conducting oil transactions in Chinese yuan. Russia has built an entire parallel financial architecture to bypass the dollar-dominated SWIFT system. Brazil, Russia, India, China, and South Africa, the BRICS bloc, have been openly discussing a new reserve currency that would end the dollar's monopoly on global trade settlement. The de-dollarization movement, which for decades was dismissed as fringe economic fantasy, has moved into the boardrooms of central banks on 5 continents. And yet, most Americans are still operating their financial lives as if none of this is happening. They are still holding their savings in the same structures, trusting the same institutions, following the same conventional financial wisdom that was designed for a world where the dollar's supremacy was an unchangeable fact of life rather than a historical circumstance that is actively being challenged. John Bogle, the man who spent 50 years studying the architecture of financial risk more carefully than almost anyone in history, would have had something very specific to say about this moment. Not what most people expect him to say, not what the gold sellers want you to believe he would say. Something more precise, more uncomfortable, and more actionable than anything the fear-based financial media is currently offering you. That is what this video is about. Stay until the end, because the final piece of this analysis is the one that changes everything else. It is the piece that was deliberately removed from public financial education decades ago, and in the context of petrodollar collapse, understanding it is not optional. It is the difference between being prepared and being among the people who walk up to a locked door and discover too late that their savings are on the wrong side of it. Before we can understand what Bogle would prescribe as a response to petrodollar collapse, we need to be precise about what petrodollar collapse actually means at the level of your personal finances, because most of the content you will find on this subject is either deliberately vague or catastrophically oversimplified. The petrodollar system does not just mean that oil is priced in dollars. It means that the entire global demand for dollars is artificially elevated by the requirement that nations hold dollar reserves to participate in the oil market. Every country that imports oil, which is essentially every country with an industrial economy, must maintain substantial dollar reserves. That means they must hold U.S. Treasury bonds. That means there is a permanent, structural source of demand for American government debt that has nothing to do with whether America's fiscal management deserves that confidence or not. That structural demand is what allows the United States to run deficits that would be catastrophic for any other nation. It is what keeps American interest rates lower than they would otherwise be. It is what gives the Federal Reserve the power to print money during crises, as it did in 2008 and again in 2020, without immediately triggering the kind of currency collapse that would follow similar actions by a less privileged economy. The dollar's reserve currency status, underpinned by the petrodollar system, is the financial equivalent of a structural subsidy that benefits every American, whether they know it exists or not. When that system weakens, the subsidy weakens with it. Interest rates that were artificially suppressed begin to normalize upward. The cost of servicing government debt rises. Inflation becomes harder to control because the dollar's global demand buffer shrinks. And the purchasing power of every dollar-denominated asset, every savings account, every money market fund, every bond portfolio, every pension plan denominated in dollars, faces pressure from a direction that the conventional financial wisdom of the past 50 years never had to seriously account for. This is not speculation about a distant future. Saudi Arabia's yuan-denominated oil transactions have already happened. The BRICS payment system is already in development. The share of global trade settled in dollars has already declined measurably from its peak. The direction of travel is established. The speed is uncertain. The destination, a world where the dollar is one reserve currency among several rather than the unchallenged global standard, is increasingly the consensus view of serious economists who have no ideological stake in either alarming you or reassuring you. Here is where John Bogle's framework becomes essential, because Bogle's most important contributions were not about stock picking or even index funds in their most narrow technical sense. They were about understanding how financial architecture determines outcomes independently of individual intelligence, effort, or caution. In 1929, 9,000 American banks failed. Not because the depositors who used them were foolish, not because those depositors had ignored warnings. The depositors had done everything right by the standards of their time. They used established banks with recognizable names. They followed the conventional wisdom. They were cautious, prudent, and responsible. And they still walked up to locked doors and found their savings gone because the architectural layer beneath their individual decisions, the institutional structure of the banks themselves, had been built for profit maximization rather than depositor protection. But here is the part of that history that was quietly removed from public financial education after 1967, the part that is directly relevant to the petrodollar story. Not everyone lost. Some depositors survived the worst banking collapse in American history without losing a single cent, and they did not survive because they were wealthier, or better connected, or more financially sophisticated. They survived because they understood something about institutional structure that the majority did not. That where your money sits is more important than how carefully you chose to put it there. The institutions that survived 1929 while commercial banks collapsed around them were not organized around profit. They were organized around depositor protection as their primary legal mandate. They were member-owned rather than shareholder-owned. Their deposits went into conservative lending, not into speculative instruments chasing the returns that eventually destroyed the banks that held them. The structural distinction, not the brand name, not the size, not the reputation, but the actual legal and organizational architecture, was what determined survival. And then there was something even more powerful that almost no one in modern financial education has ever been taught. In 1910, Congress created a system that allowed any American to deposit money directly with the federal government through any post office in the country. No private bank in the chain, no insurance fund as an intermediary backstop. The United States government itself held the money and guaranteed every cent through the full faith and credit of the sovereign. When the banks started failing in the early 1930s, deposits in this postal savings system exploded by roughly 800% in 5 years. Not because it paid attractive rates. It deliberately paid low rates to avoid competing with commercial banks. People flooded into it because it had no intermediary that could fail between the depositor and the guarantee. Not 1 cent was lost. Not one depositor was wiped out. Congress abolished this system in 1967. Not because it failed, because it worked so well that the banking industry, which had lobbied against it for decades, finally succeeded in eliminating the competition when the post-crisis political environment made its survival difficult to justify. The postal savings system was erased from public financial memory so thoroughly that most Americans today have never heard of it, even though its functional equivalent, rebuilt by the United States Treasury for the modern era, is available to anyone with a computer in 15 minutes. Now here is where the petrodollar collapse narrative and the 1929 architectural lesson converge in a way that has not been clearly articulated in mainstream financial media and that Bogle's framework makes uniquely visible. In 1929, the failure mode was institutional. Individual banks made bad loans, held insufficient reserves, and collapsed under the weight of their own speculative excesses. The depositors who survived were the ones in structurally different institutions or in direct government instruments that had no intermediary to fail. In a petrodollar collapse scenario, the failure mode is systemic in a way that is both similar and more complex. It is similar because the underlying mechanism is the same. The architecture beneath your savings determines your outcome more than your individual financial intelligence does. It is more complex because a sustained petrodollar decline does not produce overnight bank closures in the 1929 style. It produces something slower, more diffuse, and in some ways more difficult to defend against. A gradual erosion of purchasing power, rising interest rates that increase the cost of everything, and mounting pressure on government finances that eventually forces choices that affect every dollar-denominated asset. The people who built the 1929 survival architecture understood that you do not wait for the crisis to make architectural decisions. You make them before the crisis, when the signals are early and the options are still available. The postal savings system grew 800%, not because people predicted specific bank failures. It grew because people recognized early signals that the architecture of protection was worth examining before it needed to be tested, and they moved into structurally superior positions while they still could. In 2026, the early signals of petrodollar stress are visible in the same way. The early signals of 1929 banking stress were visible to those paying attention. Saudi Arabia's yuan transactions, the BRICS reserve currency discussions, the measurable decline in the dollar's share of global trade settlement, the Federal Reserve's shrinking ability to conduct monetary policy without visible inflationary consequences. These are not proof of imminent collapse. They are the same kind of directional indicators that the 1929 survivors recognized as worth responding to before events moved faster than decisions could. What Bogle's lifetime of research on financial architecture leads to, when applied to the specific challenge of petrodollar vulnerability, is a four-layer structure for protecting accumulated wealth that is precisely analogous to what the 1929 survivors used, translated into the instruments available today. The first layer is what you keep in a standard federally insured commercial bank account. This is your utility layer, not your safety layer. It exists because you need it for daily transactions, bill payments, digital commerce, and the operational mechanics of modern financial life. Keep only what you need for monthly operating expenses in this layer, because this is the layer that is most exposed to the specific failure modes that the 1929 record documents and that petrodollar stress could amplify. The federal deposit insurance coverage is real and has functioned under normal conditions. The question that the 1929 lesson asks is what happens when conditions stop being normal faster than anyone expected. The second layer is structurally different by design, and most people miss precisely why the difference matters. Credit unions are insured by an entirely separate federal guarantee system from the one that covers commercial banks. They are not owned by shareholders seeking profit maximization. They are owned by their members, legally structured to serve depositor interests first, and their deposits go into conservative lending rather than the kind of speculative instruments that can evaporate under stress. This is structurally almost identical to the depositor-first savings institutions that held firm in 1929, while 40% of commercial banks failed around them. The structural distinction is the point. Not the brand name, not the interest rate, not the size of the institution. The legal architecture of who the institution serves first when it is under pressure. The third layer is the one most people instinctively reach for when they begin to worry about financial stability, and it is the one most people implement incorrectly. Physical cash held outside the banking system is a legitimate component of a resilient financial architecture, but it functions as a transaction bridge, not a wealth storage strategy. In 1929, people who had cash but held large denomination bills found them nearly impossible to use during bank closures because merchants could not make change, and confidence in the payment system had fractured in ways that made even cash transactions complicated. The oral histories from that period are full of accounts of people who had money but could not use it effectively because they had the wrong denominations. Small bills transacted normally. Large bills did not. The modern equivalent of this layer is 1 to 4 weeks of ordinary household expenses in mixed small denominations held somewhere other than your bank. Not because cash is a good investment, it pays no yield and erodes with inflation, but because it is a bridge specifically designed for the gap between when digital payment infrastructure fails and when other resolution mechanisms come online. The fourth layer is the one that was erased from public financial knowledge in 1967 and rebuilt by the Treasury for the modern era, and it is the most directly relevant to petrodollar vulnerability of all four. The United States Treasury operates a direct purchase system for government securities called Treasury Direct. Any American can open an account and buy Treasury bills directly from the federal government, bypassing commercial banks and brokers entirely. A 4-week Treasury bill matures in 28 days, returning principal plus interest at current yields of approximately 4 to 4.25%. The proceeds can roll automatically into the next 4-week bill. The counterparty is not a bank. It is not an insurance fund. It is not a brokerage. It is the United States government itself. Either the government honors its obligation, or it does not. There is no intermediary that can fail between you and the guarantee. No bank holiday freezes this account. No bank run touches it. No deposit insurance limit applies because no deposit insurance is needed. This is the 1910 postal savings system rebuilt for the digital age. And when Silicon Valley Bank failed in March 2023 and a second institution followed within 48 hours, the people with short-term government securities in direct treasury accounts experienced nothing. The structural separation worked exactly the way the 1929 historical record said it would. Here is the connection that most financial content about petrodollar collapse completely misses. And that makes Bogle's architectural thinking uniquely applicable to this specific moment. When people discuss the risks of petrodollar decline, the standard advice falls into 2 categories. The first is to buy gold or other commodities as a hedge against dollar devaluation. The second is to buy foreign currency-denominated assets as a hedge against dollar weakness. Both of those strategies have a fundamental problem that Bogle's framework identifies immediately. They require you to predict not just that the dollar will weaken, but when, by how much, and relative to which alternatives. And the historical record on investors' ability to make those predictions correctly and consistently is nearly as poor as the record on stock pickers' ability to beat the market. The fourth layer, direct treasury instruments, solves a different problem entirely. It does not try to hedge against dollar weakness. It removes the institutional failure risk from the equation. If the petrodollar system continues functioning, your treasury bills return principal plus interest with no intermediary risk. If the petrodollar system weakens and creates stress on financial institutions, your treasury bills still return principal plus interest with no intermediary risk, because the counterparty is the sovereign itself and not any institution that could fail under that stress. The instrument is denominated in dollars, so it does not protect against dollar devaluation directly. But it removes the layer of institutional failure risk that is the most immediate threat in any financial stress scenario, including petrodollar-driven stress. This is exactly what Bogle meant when he talked about understanding what you actually own versus what you think you own. Most depositors believe that money in a bank account is their money. Legally, it is not. It is a claim against the bank, which is the bank's liability. When the bank's assets deteriorate, that liability becomes harder to honor. The deposit insurance system is designed to cover that gap, and it has worked under normal stress. The question that 1929 asks, and that petrodollar decline raises again, is what happens when the gap is wider than the insurance fund was designed to cover. Money in a direct treasury account is not a claim against an intermediary. It is a direct obligation of the United States government. The structural distinction is the entire architecture of protection. It is worth being precise about what Bogle would not say in response to petrodollar collapse, because the fear-based financial media has a specific and financially motivated interest in putting words in his mouth that he never spoke. Bogle would not say that the petrodollar collapse means the stock market is going to zero. The equity market is a claim on the productive capacity of actual companies that produce real goods and services, and that productive capacity does not evaporate because the dollar's reserve currency status changes. What changes is the currency in which those earnings are measured, not the underlying economic activity that generates them. A diversified index fund holds stakes in companies that sell products globally, earn revenue in multiple currencies, and adapt to monetary regime changes the way businesses have always adapted to changing conditions. The productive engine does not stop. Its valuation in any particular currency becomes more complex and more volatile. That is not the same thing as destruction. Bogle would not say that gold is the answer. Gold produces nothing. Its price in any currency reflects fear rather than productive value. And the historical record on gold as a long-term wealth builder compared to diversified equity ownership is not flattering to the gold argument across any 20-year period. What Bogle would say is what he said throughout his career with a consistency that became almost repetitive in its clarity. That institutional structure matters more than brand name, that the architecture of where your money sits determines your outcomes under stress more than your individual financial intelligence does, and that the time to examine that architecture is before the stress arrives, not during it, because during it the options that were available become unavailable with a speed that surprises everyone who assumed they would have time to act. In 1929, 9,000 banks closed overnight. The people who lost everything were not foolish. They were not careless. They were not financially unsophisticated by the standards of their time. They simply had their money in the wrong architectural layer when the architecture failed. The people who lost nothing were not wealthier or luckier. They were in structurally different positions, positions that removed the intermediary that could fail between them and the guarantee of their savings. The petrodollar system is not collapsing overnight, but it is changing. The signals that it is changing are measurable, documented, and growing in frequency and significance. Saudi yuan transactions, BRICS reserve currency development, measurable declines in the dollar's share of global trade settlement, a Federal Reserve that is increasingly constrained in its ability to manage monetary policy without visible costs. These are not predictions. They are facts about the current direction of the global monetary system that serious economists across the political spectrum are documenting in real time. John Bogle's entire intellectual contribution was built on one foundational insight: that the architecture beneath your individual financial decisions determines your outcomes more than any individual decision ever can. The 1929 postal savings system grew 800%, not because people panicked. It grew because people who were paying attention to early signals made architectural decisions while they still had the luxury of time and choice. Treasury Direct exists right now. Any American can open an account today. The four-layer structure that separated the 1929 survivors from the 1929 victims is available in modern form to anyone willing to spend 15 minutes understanding it. The fourth layer, the direct government obligation with no intermediary, is the most powerful component of that structure and the one most directly relevant to whatever stress the petrodollar transition produces over the coming years. The question that the 1929 record asks, and that Bogle's framework puts in terms that are impossible to ignore, is not whether you believe petrodollar collapse will happen. It is whether the architecture of your financial life is designed for the world that existed when it was built, or for the world that is actually taking shape around you right now. Those are two very different worlds, and the distance between them is where financial outcomes are decided quietly, structurally, and usually before anyone realizes the decision has already been made. If this analysis challenged something you assumed was settled, if it introduced a framework you had not encountered before, or if it changed even one assumption you were carrying about how your money is actually protected, then you already understand why this channel exists. We do not cover the news cycle. We cover the structural layer beneath it, the architectural realities that determine financial outcomes regardless of which headlines are running on any given day. Subscribe right now and turn on notifications, because the next video in this series goes deeper into the specific mechanics of Treasury Direct and how to build the four-layer structure in practical terms that any household can implement starting today. Leave a comment below telling us where you are in this process. Have you already moved any savings into direct government instruments? Are you just starting to think about the architecture of your financial life? Every comment shapes what we cover next, and we read every single one. Disclaimer: the conversation that matters is the one happening geopolitical analysis and a simulation of future scenarios, 2025 to 2026. It does not constitute breaking news or verified facts of the present. The aim of the video is educational and documentary, exploring theories of defense and the global economy. This channel supports YouTube's policies against disinformation, clarifying that everything presented is an analytical interpretation by the author.